Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back here in the home office today, delivering today's podcast. As we got a lot to talk about, we'll continue with some viewer questions here today. We got some macroeconomic news that got dropped on all of us here this morning at 8:30. So I want to make sure that you guys are aware of all that, our thoughts about that data, what we're doing with that information from a client perspective. And then really wanted to get to the main topic of today, which would be, is AI, artificial intelligence, is it becoming a bubble? So that's some stuff we're going to be getting into today. But before we do that, happy Thursday and happy leap year.
Happy leap
for all
year.
those that are, yeah. So all the birthdays on the leap years, happy birthday. It's 1 out of every 4 years, right?
Yeah.
So you guys are hopefully not working today and enjoying all that, but I don't actually know anybody that has a birthday on a leap year. I don't know if you do, guys.
I don't know anyone with a birthday on a leap year or with a child with a birthday on a leap year. So
I know. It's I know that they're out there. It's kind of like unicorns,
yeah,
but I don't know any of them. So
there'll be
it'd be great
more
to
of
get a
them
client.
today. Actually, people will be born today. So
For sure. So if it's your birthday today, let us know. Happy birthday. And here we are, February 29th, which is rare, as we just kind of highlighted here. So turning the leaf over to March, which I'm super excited about. I have a personal birthday coming up, an anniversary date coming up, and it's also March Madness. So I'm very excited to be doing a bracket with you, Ez. Although we have some biases here as Kentucky citizens and for individuals that both went to the University of Kentucky. But I know you went to other universities as I did, so we'll see who comes out on top this year. Maybe we'll take some viewer polling on that.
yeah, the other teams that I cheer for from personal experience aren't having the best years, specifically the Louisville Cardinals as well as the LSU Tigers. There's still some hope. Maybe LSU gets a good run in their conference tournament. They can make the NCAA tournament. But it looks like as far as an alumnus or a homer, the only people I'm going to have be cheering for is UK this year. So, but there's some other great teams out there. I'm excited to see how Houston does. I really like watching them play.
Yep.
Great defense, kind of mediocre offense, but really like their style. So it's going to be a fun tournament, I think.
For sure, and I'm very, very anxious to see how the Reds do this spring training, and that is also coming up here right at the end of March, actually kicking off Major League Baseball season. So we got a lot to look forward to, but we got a lot to look forward to in today's podcast as well. For those that are tuning in for the first time, listening to myself and Ezra, we love doing this. We have a blast, ton of good feedback from customers. The whole point of this show, in a nutshell, is we understand that human beings make up a marketplace, but human beings are also extremely busy world. Whether you're working from home or have to travel to a specific office location with kids, with other responsibilities, paying bills, thinking about the future for something like retirement or saving some sort of specific reason or goal, whether it's short term or some sort of long term goal like retirement. What we do know for sure about human beings from a statistical standpoint in this country is that 74% of Americans, according to a Capital One survey, feel that the number one stress in life is their personal financial situation. And on top of being very busy and potentially, anxious or nervous about their personal financial situation, we know that humans all have these smartphones, and these smartphones deliver headline news, which is great to be aware of. The news does a great job of making you aware of whatever it is that's topical, that's important in investors' minds. But what the news does a terrible job of, in my view, is providing you some historical, factual data. That way it can relieve some of that stress, saying, hey, this is important for you to understand. This is a risk that's out there that are important to investors in the marketplace. But also, here's the 25 other times that we've been through something very similar. And here's what the results were for all these sectors of the S&P 6, 9, 12 months later. News doesn't really deliver that whole picture to you, and it's not their job necessarily to do that. The news is there to provide facts, inform you, and they're there to sell ads. And the best way to sell ads is to get a human being to engage. And the best way to get people to engage is to placate to their emotions And behavioral finance has taught us that humans feel losses twice as much as they feel good about making a profit, which means we're risk averse by nature. The news understands this, which is why most of your news headlines are a little scary, to be quite honest with you. But that's how they're able to get you to engage, watching their programs, reading their articles. That's how they sell ads. I'm not knocking the news for doing their job. I'm thankful that they're there and that they are in existence. But with a human being's very busy schedule in life these days, when you see these little dings on your phone that seem very scary, and you are a participant in the market, whether it's through a 401k or whether you've hired a professional like myself, those risks are hanging out in the back of your mind. And we have all kinds of psychological data that humans could have 27 different emotions going on at any one time. Plus, there's I don't know how many thoughts that go through a human being's brain every 60 seconds. Adding that up throughout the day, what ends up happening is what Warren Buffett has identified as the number one risk that individual investors have that prevent them from achieving the types of results that they deserve consistently over a long period of time, and that is that they have no ability to control their temperament or their emotions as it relates to all these different topics and risks. So that's why we do this show. The best way for me to get control over my temperament personally, and then therefore for my customers, is understanding what other humans have done under similar events in the past relative to what's going on in the marketplace. Now I'm starting to get an idea of what probabilities are. I can start to put those probabilities in my favor. Once I have control over that very crucial piece, my temperament, now I can go about developing the second most and crucial piece to actually getting performance. And that is developing an asset allocation, which is just a fancy way of saying this is how much of Ezra's money is in stocks, bonds, and cash. And we
That's where
have
my
full
money went, huh?
control.
You've got it.
Exactly. And the great news is for the individual investor is we have full control over both of those things. So 94% of the variability of your performance in your account can be explained by your asset allocation. That's great news. You have control over that, but you have to get control of your temperament first, because if you have no control over those emotions, there's a very good chance that you're going to misalign your asset allocation relative to what history has to say. And that's where investors start to get very frustrated. They think that the market is only for those that are insiders, or there's no real way to have an advantage to outperform. So you just kind of, either index it or bury your head in the sand and throw your hands up and say, I'm just going to go back to work. That's why this show exists, is so we can give you, yes, this is what's going on today, but here's how to look at it from a historical perspective. And for all of those that are worried about compliance, obviously, history is no guarantee of future returns. Investing does involve risk, including risk of loss. But Buffett very much famously said, the one thing that we know for sure about human beings as well is that they do not learn from history. So here we are at Shepherd Wealth Management doing this podcast so we can deliver all of that information for you and hopefully help you get control over your emotions so you can make better long-term decisions with that asset allocation. Now, with that being said, we do have a lot of viewer questions that we get. We appreciate that. You can send those directly to us. You can go right to the website, shepherdwm.com. You can find all the links to our blogs, newsletters, and podcasts, find out all of the information about our firm, including myself and our president, John Ashcroft. But you can get a hold of us there as well. You can send us direct questions via text, email, simply call us, or you can go right to our YouTube page, leave a comment on any of the shows. We do recognize those, and we try to give responses as quickly as possible to that. But we also be happy to answer your questions. Now, we do have a couple here, as I know the first one resonates home with you with Bitcoin ETFs
Yeah.
and the rise in price of Bitcoin itself. Cryptocurrency is going freaking nuts to start 2024. And by the way, before we get into the topic here, 2023, that was the best performing asset class. I have to call it an asset class because it's not a sector of the S&P. I don't really know what else to call it other than an asset class. So
Yeah, it's
best
not a
performing
stock.
asset class last year and so far this year. So Bitcoin ETFs blowing up right now. I think that you gave me the statistic before the show. What would you get on the performance thus far, roughly?
Oh,
About
it's up.
50%?
Yeah, it's up 50% just this year. And we're really pushing. I think we're about, I don't know the exact numbers specifically, but I want to say at the height of the Bitcoin craze when we were all locked in the pandemic, I think it capped out somewhere around 66,000, we'll just say.
Yeah,
And
right
this
around
morning,
where we're at.
yeah, this morning when I opened up to check my portfolio that was trading at about 62,000. So we're virtually back up to where it was. And we saw lows at the beginning of 2023.
Yep.
Bitcoin was trading at 11,000. So just in those 14 months, it's almost quadrupled in its value. So
Now, I've gotten two
or
questions from customers.
quintupled, whatever. What, five times? It's five times.
There you go. So we got, I actually had two direct questions from customers yesterday on this specific topic. And I know that Bitcoin ETFs were up like, I think like 7%. It was when I got the phone call yesterday afternoon. So two customers asked me about adding, Bitcoin ETF as part of their asset allocation. And here's my response to that. First of all, I think that the rise in price of Bitcoin had, at least recently, has a lot to do with two things. Number one, just having the ability to own Bitcoin through an ETF opens it up to a lot more individuals, a lot more individual investors. They're investing at Robinhood or Fidelity or Charles Schwab or pick your brokerage outlet. It's much more easy for them to get access to this asset class through an ETF because ETFs are generally traded just like a stock, can be bought and sold within less than a second. So there's some liquidity there that provides some confidence for individual investors. So that helps, the individual investor being able to allocate dollars to cryptocurrencies through the ETF. I think has something to do with the recent rise here in the price of cryptocurrencies in general, but we'll just pick on Bitcoin here for today's conversation. That's one of it. The other piece of it is, to me, and I've talked about this all year long, this is a risk on year. We do anticipate double-digit returns in the S&P. S&P is up roughly 7%, not quite, so far this year. So we're definitely on pace for that. And when interest rates are likely to be cut at some point this year, the market's pricing in 3 rate cuts at this point, which is good. It's kind of in line with what the Fed expectations are with rate cuts for 2024. So that's good. The market's kind of married that up. But when you have interest rate cuts, that is very much a risk on trade. That's why we really like small caps as an example, as an asset class that has historically performed the best, do get our first interest rate cut. So as a risk on trade, of course, it doesn't get much more volatile. To Ezra's point, we went from 11,000 to 64,000 in less than 18 months. Crypto is a very volatile asset class. And when you have a risk on trade, those types of riskier investments tend to do their very best because you're accepting more risk, right? It makes very much a lot of sense to me as to why you see that. So the question is, why am I not participating in this myself, number one, and then therefore for clients? So for myself, and I mention this a lot, I'm a big Warren Buffett, individual follower for a lot of very obvious reasons, is that when you go about pricing securities, you have to use some sort of discounted cash flow model. There just isn't any cash flows. There's not a balance sheet or income statement for me to look at. Therefore, the price of these cryptocurrencies are really just based on what somebody else is willing to pay. And that's my issue, is I can look at a stock or an ETF or a basket of securities, and you can start to get some ideas of fair market value, overvalued, undervalued, et cetera. And that's how we go about, obviously making some decisions, and we placate that or overlap that with historical data. There really isn't any of that to look at for crypto. You're really just kind of banking on holding an asset, whether it's through an ETF or just direct cryptocurrency transaction. You're just betting on that somebody else in the future might be willing to pay more for it. And you could say, well, that's the same thing true with stocks, but stocks are priced based on cash flows and interest rates. Essentially, you're using some sort of discounted cash flow model to come up with an intrinsic value that you believe is either fair value, overvalued, undervalued. And I just don't have that ability to do that with crypto, which for me is the barrier to entry for my own investment dollars to go towards that type of asset class. And if I feel that way personally, I would feel very much like a hypocrite if I were to do that for individual customers here as well. But with that being said, what I also told these customers when I got these phone calls about adding Bitcoin ETFs to their portfolio, I did say this: in investing, when you have a new asset class that you could participate in that there's a whole lot of questions about, if you can't simply help yourself from not owning the new thing, in this case, Bitcoin ETFs, then own them, but own them in a smart way. Maybe 1% of the value of the account. right? So if you got $100,000 in a brokerage account, maybe put $1,000 into something like a Bitcoin ETF. And the reason why I say that and that use that percentage is because pretty much everybody that is investing, if you have 1% of your liquid net worth in an asset class, whether it's crypto or something else, and that asset class goes to zero, which is a potential concern for a new asset class, your lifestyle is likely not going to change. It's not going to be fun. You're not going to like losing that 1% if that were to happen. I
Yeah.
certainly don't hope that that does happen for any investor that's out there. But if you had 1% investment in something, pick your favorite asset class, and that went to zero, meaning you lost all of that money, there's a really good chance your lifestyle didn't actually change. So if you can't help yourself, own it in that respect. But that's my thoughts and feelings about it. As I know that you're directly invested in that in a bigger way. But yeah,
I am.
that's kind of how my thought process is. And I don't know if you would take it any farther than that, but that's the advice I've kind of given customers so far with this new thing. And I'll end it with this: Warren Buffett himself did not buy Apple when it was trading at a dollar or anywhere close to a dollar, right? I think his first entry point into Apple was 2017, which is essentially the peak of the iPhone cycle. Like Apple was just hitting on all cylinders with iPhone sales. And a lot of people felt like that was roughly around peak iPhone sales at that time. And Buffett entered Apple stock around that time, 2017. I have to go back and fact check that a little bit, but that's about when I think his first initial investment was, at least in a big way. And obviously, he's held on to that. He's recently trimmed a portion of his Apple shares because it was 50% of the value of his entire investment portfolio. It's grown that much. My point is, it's grown a ton from 17, his first investment, all the way till now. And he's made billions and billions of dollars on that trade. I don't feel like I need to be first to that asset class in order to make money. So in other words, if cryptocurrency now becomes something that every institution and every sector is benefiting from, and you can clearly see how that's applying to cash flows and all that sort of stuff. I might be wrong today, not owning Bitcoin and where it's trading at, and maybe years from now it is extremely popular, and you can see all the benefits. You can actually quantify it at that point. I would actually feel like Warren Buffett when he made that first Apple transaction. You could say, hey, Mr. Buffett missed out on the first $1 trillion worth of market growth for Apple. Okay, that's fine. He entered in when he entered in, but he still made a ton of money after it. And I feel like I could do the same thing for crypto later on down the line if I happen to be wrong about it. So that's the advice that I've given to customers. I don't know if you want to take it anywhere else from that, as, but that's kind of where I'm leaving that one.
Yeah, totally. I mean, just starting with that advice, I think that that's 100% the way to go. If you haven't already, found that crypto is an asset class for yourself, you don't have any experience with it. And like you were saying, the ETFs are now what's more enticing to you. Definitely enter into it with caution. Don't worry. I mean, you can't, nobody can go back in time and take advantage of the pandemic and, different asset classes. Even basketball cards are blowing up, right? People were selling odd things and making money. So get that out of your mindset. I had a person that was, kind of a mentor helping me when I was beginning my, you know, life as an investor, coming up with, how I wanted to kind of start putting together a portfolio once I was able to financially do that with myself. And they flat out told me that you do not count the profits. It's a long-term thing that everybody would love to have, the winning lottery ticket or get in on the ground floor. But if you try to time when and how to get into the market, as opposed to making sound decisions, you're going to end up probably losing more than you make. So for me, I had been following Bitcoin for over a decade. I mean, it was enticing just with the things that I studied in school and where it was in my life when Bitcoin came out. I was aware of it and I didn't invest in it until, much later than that. But I dollar cost average it. It's just a part of my weekly input
Yeah.
into the stock market, and it has been for a few years now. So the
Yep.
returns that I'm seeing on it have taken advantage of all the swings and the undulations. I certainly didn't sell when it was at its highest, but I kept buying even when it was at its lowest a few years ago. We just talked about the last like 4 or 5 years, the cycle that we're mentioning on this podcast. So it
Yep.
has worked out for me, but it isn't something that I am cashing all in. Certainly Bitcoin and even like Ethereum and a couple other cryptos, which we'll save for a different podcast. They have shown to be actual currencies in their own right and actual asset classes, and they aren't scams like you see about, all kinds of everybody had a coin 2 or 3 years ago, right? I mean, and still
Right.
now people are thinking that they're going to make NFTs and their own cryptos, and you got to watch out for those. But um, again, it'd be a different lecture. I don't want to get us off of what you prepared to talk to folks about today. I know we got a lot of financial news, macro. Sorry, I got tongue tied there. We got a lot of stuff to talk about, but it is an actual asset class, and I think you're right. If you haven't entered into it right now, do not cash all your chips in because it's going to undulate. It is volatile, and it is a long term game. But in my opinion, it is not going to go away ever. So there will be other moments to take advantage of large spikes um, in its volatility if it does continue to kind of behave that way.
Yeah, well said. I think the dollar cost averaging piece was the big takeaway I think investors should take from that. As is that even though you didn't sell out at the top and now you're getting back to the top from where we were just a few years ago, the fact of the matter is you did your homework, and that homework, that preparedness, is what gave you confidence to continue to take your hard-earned dollars every week and dollar cost average, even when it was trading at 11,000.
Hmm.
And that's really the secret sauce is you were able to control your temperament. How did you do that? You did your homework. Once you understood, what the homework was telling you, now it gave you confidence to go ahead and have that asset class as part of your overall asset allocation. You were able to stick with it. So that was the key takeaway that I heard,
Yeah.
and I just wanted to reiterate that for everybody. Now, that's a perfect segue, though. I want to hit this real quick. So we got the CFA Institute. For those of you that don't know what a CFA credential is, it's the only credential that I don't have in the finance world that matters anyway. And the CFA is extremely difficult to pass. It's extremely difficult exam to get through. It's a three-part exam. You have to pass it on a certain window. It's very difficult. The failure rate is very, very high. And it's very much mathematics based. I'd say the big chunk of it is accounting, and then the other part is math, specifically statistics. And I attempted to study for this, and I got to tell you, it is a bear, man. It's CFP exam is very difficult. Took over a year to prepare for. There's a lot of requirements to become a CFP. You can Google all this stuff, but a CFA, the credentials are they carry a lot of weight in a room. I'll say that. At least I have a hell of a lot of respect for those that have been able to get a CFA. Now, I will tell you this: there's a lot of CFAs that aren't that great investors, but these are very, very intelligent people. So they came up with a list. My point is this: they came up with a list recently: tips for avoiding the top 20 common investment mistakes. I'm going to rattle through some of this because some of it's very good, some of it is something that we talk about all the time, and there's some stuff in here that's just plain wrong or dumb, in my opinion. So I'm going to give this to you. And you can Google this as well. So CFA Institute tips for avoiding the top 20 common investment mistakes. Number one, expecting too much or using someone else's expectations. Okay, so set the proper expectations. I get that. And when I ask clients here about expectations, I'll just say, hey, if you and I, as we're interacting or engaging for the first time, you're not a customer, I might ask you like, hey, what is your expectations of the market? Some people have too wild of an expectation. Some people too conservative, and very very rarely are people like kind of in between all of that.
Yeah. Give me
Second thing,
5 to 8% over the rest of my life.
yeah. The second thing, not having clear investment goals, that kind of ties into the first one. If you have expectations, there's generally some sort of goal attached to it. And people might think, well, I just want to make more money. That's my goal. Well, why do you want to make more money? What does that money represent? Why are you even putting it in the marketplace at risk at all? Why not just put all your money in real estate or some other asset class? So setting clear goals is very important. I would agree with that one. That's key. I'm glad that that's second on the list here. Number three, failing to diversify enough. This is a tough one. So Warren Buffett, Charlie Munger, rest in peace. But Buffett and Munger said this many, many times. You can just basically go to YouTube and type in uh, Berkshire Hathaway shareholder meetings, and you'll get clips of Charlie Munger and Buffett answering questions about diversification. And Buffett and Munger both agree that diversification is the death of performance. Portfolio, because this number three here says failing to diversify enough. Well, more often than not, when I'm sitting down with a brand new prospect, potential customer, they're way more diversified than they ever should be. And essentially, they feel like all of those different individual holdings or those basket of mutual funds that they might have 15, 20 different funds. All of those funds are investing in hundreds of different securities. And at the end of the day, you end up with a ton of overlap. You basically are the S&P 500 at that point. You're just paying five, six, seven times more than what you should
Yeah.
to be invested that way. So that's to me, I don't like that sitting there at three and diversifying enough. What I see is too much diversification, and those that over diversify. Buffett said this famously too, and it's damn true. Um, Not only is diversification the death of performance, but diversification is really for those that don't know what they're doing. So I see that quite a bit, and I don't think that that is phrased correctly in my experience. Number four, focusing on the wrong kind of performance. Yeah, that's kind of a dumb one. Let's see, we're a five. Buying high and selling low. Like that's the dumbest thing I've ever heard. What is your investment strategy? I want to buy low and sell high, which is the opposite of their number five risk here. Like that's obvious, right?
Right.
Clearly, we want to buy assets at a lower price, sell them at a higher price,
Yeah.
and I don't know why that's sitting here at five, but
Yeah, I'm looking to get taken to the woodshed on this one. Can we buy at the peak and sell when it
yeah,
drops out?
I don't know. I don't get that one, but that's in there. That's number five. Number six, trading too much and too often. That is a big one. I don't think that it's necessary to turn over the portfolio that much, but I also think buy and hold forever, which has very much been a Buffett strategy that does. I think you should have core holdings.
Yeah,
Your core holdings, and this is a whole nother podcast. Maybe take a note of this, Ed, and we'll do this pretty soon.
sure.
So core holdings and an asset allocation. So pick on technology since that's the biggest sector of the S&P 500 by a long shot. You want the companies that have the biggest mode of safety. What I mean by that, if you think about a castle back in like when Vikings were raiding England and all of Europe and so forth, if you were the owner of that castle, you're the king of the Providence or whatever. The wider that moat is and the taller your towers, the safer you felt. Well, for companies that can diversify their revenue, generating revenue across multiple different streams, Apple is the easiest example. They have hardware and software. They make chips. They do all kinds of stuff. They sell services. They're making money. They diversified their revenue as an entity, as one company, in so many different ways that they've widened that moat. Like, who's going to take Apple head on? I can't think of anybody. So therefore, they have a huge moat of safety. That is a core holding. The question is, should you be overweight or underweight Apple stock or Amazon stock, or pick your favorite large tech company in this example? That's a different conversation. That's going to be based on idiosyncratic things about that company and their management team. It's also going to placate into historical data as well as current macroeconomic events. So trading too much definitely is a problem for a lot of individuals. Time in the market is way better than trying to time the market. I give you guys statistic after statistic of being investing for 30 years and just simply missing the best 10 days of the market over that 30-year period of time. I mean, your performance is going to drop by like 40% or something staggering like that. So trading too much is a problem for a lot of individual investors. So please try to avoid that. Number seven, paying too much in fees and commissions. Obviously, we just talked about that. Some people are so over diversified that they end up paying five, six, seven times more than what they should. And for those that just hire advisors without asking those types of questions, will end up probably paying more in fees than they should. So that should be one of the first questions that you do ask a advisor. Number eight, focusing too much on taxes. That's a big one. This is tax season, and a part of what we do for large households, $500,000 that we manage or greater for a household, we do have our CPAs prepare and file their taxes. We pay for that tax preparation and filing as part of the overall service. But I will tell you this, as much money as we made for customers last year, on average, a customer at Shepherd Wealth Management had a 35% performance. The S&P was up 24, so we outperformed by about 11% for 2023. So we did great for customers, a lot of profits. Some customers need money every month. We have to sell things at gains, and therefore there's taxable events. I think that there's a lot of people out there that would rather lose money than pay taxes. That's the wrong kind of mindset. And I don't want to pay any more taxes than the next guy in this country or gal. But the fact of the matter is, Ed, if I had a stack of $100 bills, and it was, $150,000 worth of gains that you had that you realized, like it's real money stacked up on my desk, $100 bills. And I slid it across the desk to you and said, "Hey man, you had a great year. Here's your return." And the tax man was sitting right next to you, and he said, "Hey, Ez, I'm going to need 8,000 of that to pay for the capital gains tax." I think that you would take that trade off every single year, personally.
I would, and then I
there,
would take that tax man out for margaritas and some queso, like,
there's
immediately.
a lot of people that would rather just have, had a wash or even lost a little bit of money so they didn't have to pay that. But if you're taking money out of your account, folks, you got to sell things. You're going to have gains. If you do have losses, offset the gains with losses. That's a no-brainer. But paying taxes is a function of making money. I would rather make money all day long knowing that I'm going to have to pay taxes as opposed to not. Number 9, not reviewing investments regularly. We do that quarterly. That's very important. Taking too much, too little, or the wrong risk. I don't even know what 10 even is about. That's kind of like a
You're
catch-all
playing,
phrase.
you're
Right?
risking. I mean, yeah, what is that? Like,
I don't even know. Not knowing, number 11, not knowing the true performance of your investments. Most people that hire an individual advisor aren't as transparent as we are. So we have an app that gets right to your performance. We talk about performance. We don't hide from performance. Performance is one of the big pillars here at Shepherd Wealth Management. We have 3 of them: performance, purpose, and passion. We lead with performance because I know it's what investors care about. Know your performance. Know what you should expect from your performance from your advisor. That should be day one table stakes up front. Here's what you should expect based on your goals, risk tolerance, and time frame. And we're going to hold ourselves accountable to that. We're going to review it regularly, like number 9 is talking about, to make sure that if you're on pace, ahead of pace, or behind pace to achieve that specific result for you. Number 12, reacting to the media. To me, this should be number 1. But yes, that's in here. That's why we do the show. And number 13, chasing yield. There's a lot of people out there, unfortunately, that go for the highest dividend or highest interest rate on a bond. And I've seen that bite people very, very hard because you're only focusing on one tiny piece of data when there's all these other components. For example, AT&T shareholders. I feel bad for all of you guys. You were looking at an 8% yield on owning AT&T shares. That sounds amazing, specifically when the S&P 500 yield is like 2.5%. You get to own AT&T and get this 8% yield. At least that's what it was at one time. The problem is AT&T, unfortunately, has lost market value greater than 1%. So even if you're clipping 8% dividends on a quarterly basis, if the stock goes down by more than 8%, you're still in the hole. So that doesn't make any sense to me either. Even if you are living off those dividends, there's a smarter way to go about building an income stream for yourself to live off of, if that is the goal, without necessarily chasing individual positions or bonds that are showing a very attractive yield. 14, trying to be a market timing genius. Obviously, we've already talked about that. 15, not doing due diligence. This is why it's so important to look at what the history has to say about the market. I think that should be much higher than 15. 16, working with the wrong advisor. That's kind of a no-brainer. I can go off on a complete tangent about what I would deem as a good advisor setup versus a non-good one. Number 17, letting emotions get in the way. How is this freaking 17? Like, that's unbelievable. That should definitely be in the top 2. 18, forgetting about inflation. All right, that should be in there. 19, neglecting to start or continue. Okay, that should be in there. And then,
That's ridiculous. Like, hey, the bet make sure you do it. That's what they're
yeah,
just saying.
yeah.
Make sure you invest. That should be maybe the first thing. Like,
I
just
kind of
do it.
feel like that. It's like they put some of this in here. It's kind of like that scene from Tommy Boy when on the plane, and David Spade is on the mic, and Tommy has to like do the belt buckle clip thing, and
Yeah.
David's like, "Hey man, if you don't know how to buckle your seatbelt, Tom would just come back here and hit you in the head with a tack hammer." I feel like that's how some of this is reading to me. Like, come on, get started. Okay, thank
Yeah.
you. Number 20, not controlling what you can. How is this 20? I don't know. But there are 2 things investors control. We've already talked about them today. One is their temperament and how we do that, understanding what human beings have done in the past, what history has to say. And the other thing that you can control is your asset allocation. Those are the only 2 things. We can sit here between now and Christmas time talking about the stuff you can't control, but there you go. CFA tips, CFAs are smart people.
Yeah.
That list was okay. The order was, I would have changed it completely. And I don't know if we need all 20 of those in there. So check it out for yourself if you'd like to, but that's our take on that.
Yeah, some
All
of that
right.
kinda read like the last couple paragraphs in a mandatory length middle school essay, where you're just filling it. You're just like, "We gotta
Yeah,
hit 20, that was the assignment." Like,
you're right about that. That's a good way to look at it. But we'll shift gears here. Macroeconomic events today. News of today. Very important. We got what the Fed's favorite inflation gauge is, what they call core PCE index. The street consensus was 0.4% month over month. That's exactly what we got. So we got an inline inflation read, 0.4. Market reacted nicely to that, and it's kind of holding on to gains right now. So that's encouraging to see, at least on the short term. Unemployment rate. I'm sorry, the initial jobless claims is what it was. Street was looking for 210,000 initial jobless claims. That jumped up a little bit to 215,000 initial jobless claims. So really what we're saying here from a macroeconomic event standpoint is inflation came in line with expectations. At least the Fed's favorite gauge of inflation was in line with expectations. And the job market is continuing to be robust. I mean, a small tick up in initial jobless claims certainly isn't anything to panic about by any means. So essentially, everybody that is looking for a job has a job, which is 70% of this entire economy is based on the consumer spending. As long as the consumer's flush, the economy likely is going to do very well, which we're seeing that in real life data from an earnings perspective. So we basically have wrapped up earnings season for this Q1 earnings, and of the 96% of the S&P 500 that has reported, so we'll get the other 41 companies reporting this week. So at the end of this week, earnings season is now officially over, but we're basically there anyway. 96% of the S&P has reported. Of those that have reported, 76% of those companies are beating analyst estimates, and they're beating by a median of 7%. So extremely strong data, both on the consumer side as well as corporate earnings, and inflation has still been, in check thus far. I know we had a hotter CPI, PPI reading in January than we were looking for, but generally speaking, in January, there's a lot of seasonality in the data. I think there's some noise in it. We got very similar data points last year, and we also saw inflation fall precipitously throughout all of 2023, and I expect that to continue. So really nothing has changed for us from a playbook perspective so far. Now, looking forward, after a great earnings season, we have a couple big things coming up here in March, outside of my birthday. But the first one would be March 12th, and we will get a fresh look at February CPI. That comes out on March 12th. And just a few days later, a week later roughly, on March 20th, we will hear from Fed Chairman Jerome Powell himself on what they want to do with interest rates, their thoughts on the economy, etc. Now, as we talk about interest rates, the Fed meeting on March 20th, they will make an announcement on whether they'll hold rates steady, whether they will increase rates or decrease rates. Right now, as we're sitting here talking, I am literally on the CME Group website, which is their Fed Watch tool. They literally have a countdown here. It's almost like they're counting down for, the NFL draft. There's exactly 20 days, 2 hours, 28 minutes, and 19 seconds to the next Fed meeting. And right now, there is a 97.5% probability that they do nothing with interest rates in March. As we flip the calendar over to May, which the next Fed meeting would be May 1st, I've been calling for the first 25 basis point rate cut to actually happen in May. Probabilities are dropped though. There's only about a 23% chance that they actually do a rate cut in May as of this moment. And if we go 1 month further, which would be June 12th, there is roughly about a, call it 50-50 chance that we'll see a rate cut. So probabilities have shifted out a little bit for rate cuts, which isn't necessarily a bad thing. It just kind of delays that gratification, but that's the data points as we look forward to the next CPI print that we're going to see. Now that we've gotten through some viewer questions, the macroeconomic data, which has been good, inline inflation, strong jobs still, earnings excellent. Fed's taking all this into consideration as they come into their March meeting, basically expecting nothing to happen. and the market's likely going to trade in March based on whatever it is that Jerome Powell has to say about inflation, the future path of what they're going to do with interest rates, the timing of which they're going to do that, which he's not going to give you. He's not going to say, hey, as we're going to, we got like in the room here, we got like a 97% chance of a rate cut either in May or June. He's just not going to freaking tell you that. So he's going to have to dance around all those questions he's going to get. But that's what we're going to look forward to. And I think that's largely how the market's going to trade, is based on his comments, because January, we've got off to a great start, positive January. We got a positive February. None of these things have happened positive January and February for decades. And now we have a very important Fed meeting with no new real corporate news until we get into the second week of April, when we kick off another earnings season yet again. And then, of course, the market will take all of that and start to price things in. So really, we're in this dead period at the end of this week. Coming into March, we have really a couple of important things, like I mentioned, the 12th and the 20th. But other than that, you're just going to hear all the talking heads, the market pundits, giving their opinion about what the Fed is likely going to do with interest rates in 2024. So because of all of that, we're anticipating some volatility to take place in the market, and we're prepared for our customers by readjusting their allocation, taking profits, raising some cash, and being prepared to implement that cash into our favorite asset classes if we do in fact experience that kind of volatility coming up here in March. That way we can be fully positioned in the types of things that we believe would historically, or would do the best historically, when we do in fact get that first interest rate cut. So that's what we're doing with the data that we have thus far. And so far, it's been playing great to our customers' hands. The market, as I mentioned, is close to about 7% year-to-date gain. As customers here at Shepherd Wolf Management, on average, we're doing a little bit better than 7% for them, even with all that cash that we've been holding on to here since about the beginning of February. So very excited to get this data, but I'm also being patient in how we go about implementing the cash that we have into the asset classes that we want to have a lot of ownership to. Now, the big topic of today is inflation, or I'm sorry, is AI, artificial intelligence, is it a bubble? Now, this is, no, I guess we'll take your polling opinion first here. Any thoughts on that, Ez?
I think it's the driver du jour at the moment, when everybody kind of starts to see it settle down and understands it's here to stay. Maybe its ability to kind of drive attention and headline news is going to wane. But no, I don't see it as being in a bubble. It's just going to be a part of things going forward. So.
I agree. I can give you a ton of different historical data points, and I might here, depending on time, Ez.
Yeah.
But here's what I wanted to drop on people here this morning. So we just got out of earnings season. I just gave you some of that data points. Here's what we got. The S&P 500 added $35 billion in net income in the fourth quarter of 2023 versus the fourth quarter of 2022. So year over year, 35 billion the S&P added in net income, which is a 7% earnings per share growth. The contributions really came from two companies, NVIDIA and Amazon. NVIDIA itself added 10.75 billion in net income in the fourth quarter of 2023 versus the fourth quarter of 2022. Amazon added 10.3 billion over the same period of time. NVIDIA is 31% of the earnings per share growth, and Amazon is 30% of the earnings per share growth of the S&P. These two accounted for 61% of all added net income. AI and the associated ecosystem is adding up to real spending and growth. That's really what that data point means. This is a very strong argument against those deeming AI as a bubble in our view. And in fact, NVIDIA's forward free cash flow yield of 3% is about the same as the S&P 500's 3.5% free cash flow yield. And the question is that I have for the audience taking in this data is, since when is a bubble seeing free cash flow yield just a touch lower than the overall market? I mean, you can't call it a bubble, no. In my view, at all. Based on this data, I mean, you're really seeing real life spending and growth right there on those couple data points. So it is not only here to stay, it is likely that we're living in a super cycle of productivity growth right here in this country. And as we talked about, going back to, I believe it was January of last year when we wrote that news article and made a case for double digit growth, we pointed to a huge problem that AI actually solves. So there's also been historical data points going back to the 70s and before. So think about it this way. The tech sector, 30% of the S&P. Tech is one of 11 sectors in the S&P. Healthcare is the second biggest sector, 15%. So tech dwarfs everything. Well, if you go back to the 20s, I mean, tech really wasn't a sector at all. We had banks, we had manufacturing companies. I mean, that was the market essentially. And now tech is the largest sector in the S&P. How'd that happen? Well, we've had other points in time where there's been labor shortages. We all heard labor shortage was a big problem during the pandemic and then coming out of the pandemic. And it still is a problem. We still don't have enough people in this country to do all the jobs and tasks that corporate America really needs to have done. And this is not unique to this era. This has happened in the past. And technology got as big as it did as a sector in the S&P because CFOs and CEOs, when they can't get enough people to do a job or a task, well, they have corporate earnings they got to produce every single freaking quarter, and they'd like to keep their positions. So what are you going to do if you can't get enough people? We're not going to wait around for Congress or the government to pass some immigration laws to get more people in this country to do those jobs. You can't wait that long. You don't know when or if that'll ever happen. And now, to my knowledge, you can't clone people yet legally. So you
Legally,
have to count.
legally.
You have to count on technology, software, robotics. You pick your adjective to solve that problem, to fill in the gap. So software can automate some of these things and free up human beings to do other things. So that's been around. That's how technology got to 30% of the S&P. It's likely that you're going to see that continue to grow. And I think in 10, 15 years, tech is likely going to be 50% of the weighting in the S&P 500. And maybe we won't even have all 11 sectors. Who knows? But there is historical precedent. That's how tech got to where it is. This is the problem that tech is solving right now. And that is why artificial intelligence is getting the type of premium valuation on companies like NVIDIA and Amazon that you're seeing, Microsoft and others, that it deserves to get. Because you're actually seeing it not only in earnings per share, but you're seeing true, real earnings per share growth. You're seeing some of the biggest companies here, playing into that. So this is a good thing for corporate America. It's a good thing for market participants. It's a really good thing for employees. Long term, there is historical evidence of this, and that's why our core holdings, from a tech standpoint, are likely going to continue to be the players that have this big mode of safety in this artificial intelligence space. So to answer the direct question that you're reading, by the way, in Barron's, so these are questions that you're seeing in Barron's and other different media outlets. A lot of talking heads talking about an AI bubble. To me, it's just complete nonsense. And I wanted to throw some cold water on that this morning. Don't know where we're at exactly on timing, Ez. I could definitely talk a little bit more about some of this stuff, but that's the view, both in real life data now and how that kind of ties into historical data and our thoughts about, technology as an asset class and the core holdings that we have there for our customers. So where we at, Ez? I have no idea where we're at on time here. We're typically running up on our 40-ish minutes.
Yeah, we're actually just under 50 minutes.
All right. Well, this is we'll have to save some of this other stuff for another time. I know there's some other things I wanted to talk about there today, but really enjoyed the show. Went by in about 5 minutes in my mind.
Yeah.
Hope you liked it as well. Love to hear your comments and feedback. Don't forget, we're doing this about every 2 weeks. So you guys will catch us again in March. And you can always go to shepherdwm.com to catch future shows, previous shows that we've done, and all the previous newsletters, blogs are right there for you as well. I hope you guys have a great February 29th, and looking forward to turning the page to March 1st tomorrow. I hope you guys have a great rest of your day. Take care.